There's one slide that I'll get to show you if you haven't seen it already. It's interesting, if you try to find the causal factor in all this, I wonder if this is just it, David, or not, if you agree. But if you look at total financial assets and who owns them, 84.5% of total U.S. financial assets, i.e. the markets, are owned by the top 10% of the people. So isn't that the point, is that people that have the money want to perpetuate the asset inflation and the rest of the people get the cost of living inflation in exchange for that?
Yeah, but it's even worse, and you've hit the nail on the head in terms of my book. I have a chapter called The Warren Buffett Economy.
Really?
And it's a metaphor, but what I'm trying to demonstrate is that once we went down the road of what I call Keynesian central banking with Greenspan, we had a huge financialization of the economy. So what I do in this chart is I take the sum of debt outstanding plus the market value of equity relative to GDP. Let's call it the financial ratio of the economy. Back in 1987, there was about 9 trillion of debt and market cap outstanding. The GDP was half that. The ratio was 2 to 1. Today, this is a startling number, it's 93 trillion. The value of debt, which is 64 trillion, plus the market value of equity is 93 trillion. We know the GDP is 18. We're at 5.5 times. Now, that huge increase in what I think you could call the capitalization rate for the national economy is not warranted by the performance of the national economy. In other words, as everyone knows, productivity has been declining. Investment in real terms after depreciation has gone negative. GDP growth is at, on a trend basis, less than half its historic level. So you would say that if a entity, whether it's a business corporation or a whole economy, is suffering from a diminishing performance and growth rate, you would expect the cap rate to go down, not up. But our cap rate has gone from 2 times to 5.5 times.